presentation.
Awesome. Am I ready to go?
Wait, let me check first the YouTube. All right, you're good.
Okay. Thank you, folks, for joining me in this last minute live put together. Basically, on Friday. By the way, before we begin, my name is Faizal Garasia, and I am a mortgage agent with Dominion Lending Center Mortgage House. And before we begin, I'll give you a quick best practices for live. A quiet place is good. Headphones are great. Mobile on silent mode is fantastic to have. Best to avoid multitasking. And sitting down helps you stay present. The topic today, this is a last minute presentation that I put together because on Friday, when on Friday, Silicon Valley Bank in USA was in liquidity crisis, and which is sort of going towards other banks as well. Sterling is the next one in line, so I'm doing this live to sort of explain as to what's really happening behind the scenes. Thank you for attending. The presentation should take about 20 to 30 minutes. It says 10 to 20, but trust me, it will take a little longer. Please ask questions in the comment section. I will respond after my presentation. And at the end of the live, you'll learn why there's a sudden collapse in the bank in US since last Friday. Connect with us. Call, text, email, Facebook, Instagram, TikTok, anything you want to, and there's the website as well. With that being said, Silicon Valley Bank is a commercial bank headquartered in Santa Clara, California. Now, it has its operations in several different countries, Canada being the neighbor, China, Denmark, Germany, Israel, Ireland, Sweden, and of course the UK. Canada's banking regulator has temporarily seized all the assets of Silicon Valley Bank's Canadian branch after the financial institution collapsed on Friday. Now, what happened there? On an outstanding speed, March 10, Friday, Silicon Valley Bank went into liquidity crisis. It is said to be the second largest bank failure since the Washington Mutual Bank in 2008. Now, I never thought we would see 2008 again. 2008 was the beginning of my career. I was at TD, and I understood most of it, but I was in a customer service role at the time, and it was chaotic. I was the front line, and it was a bit of a challenge, and yeah. But in any case, why the sudden collapse? Now, Silicon Valley Bank's collapse came suddenly. It was very quick, almost overnight, following a frantic 48 hours during which customers yanked deposit from the lender. Now, the SVB, Silicon Valley Bank, is the lender. In a classic run on the bank. Classic run on the bank meaning, if you can visualize, literally people are standing in the line asking for money. Online, they're going, transferring out. That's what is defined as a classic run on the bank. But the roots of it, demise, go back several years. Like many other banks, and this is the line I'm using, like many other banks, because there are other banks that have done exactly what Silicon Valley did. They plowed billions of dollars into US government bonds during the era of near 0% interest, because of course the banks want to secure their funds, and investing into government bonds is one of the safer things to do. So of course they did that. Was there anything wrong with it? No. However, there is something wrong with it, and we'll work through that next slides. Now, this past year, the interest rates are continuously rising to fight the inflation. We all know that this has been something we have been working on. Like uh, you look good in brew. Thanks. This past year, the interest rates are continuously rising to fight the inflation. When the rates rise, what happens is, by the way, bond is a financial asset, and every asset has some level of fluctuation in their fair market value when it comes to interest rates. So, because bond is a financial asset and it's a fixed asset, um, it falls in value if the rates go up. So the jump in the rates takes some of the value off the bond portfolio. That's what it did for Silicon Valley Bank. And I've explained quickly at the bottom. A bond is a debt security, similar to an IOU. Borrowers use bonds to raise money from investors willing to lend them money for a certain amount of time. Now, the time is the critical point. That's what led to it, and I'll explain further in other slides. But the mismanagement of the time is where this problem has come. Um, and of course, there are a couple other factors, but that's the trigger point. What sparked the bank run? Well, while Silicon Valley Bank's problems can be traced back to its earlier investment decisions, the run on the bank was triggered Wednesday when the lender announced that it had sold a bunch of securities at a loss and would sell 2.25 billion in new shares to plug the hole in its finance. So what happened in last year, in US, there have been 7 different interest rate hikes, and every change and increase in interest rate affects the value of the bond. What it does, it lowers the fair market value of the bond. It has an inverse relationship with the interest rate. So interest rates go up, the bond value drops. So when that happens, it's clear that every single time interest rate went up, the bond value dropped, right? So over time, after 7 increases, last increase for US was in February, it has a reduction in its asset value, and therefore, if you want to be liquid, you're selling at the fair market value, and because you're making such a huge trade, of course, the market will not give you what you're asking for. It will be slightly lower because you have a huge effect on the market. There has to be a big buyer. It's a big trade, or there has to be many buyers to fulfill that trade. In new shares, there's a hole that comes where they're willing to issue shares. The bank stock plummeted 60%. Of course, when the bank says, "Hey, we have a financial problem, and we have a hole of 2.25 billion, we're willing to issue new shares," of course the share values are going to plummet. No questions. Financial markets have some of the smartest people, like numbers savvy, some people that live, eat, breathe numbers all day, every day. So the stock plummeted instantly Thursday and dragged other bank shares with it as well. because now investors are questioning the banking system, even though the banking system has its own solid foundation. When there is a one weak player, let's just say, you do end up questioning the team with it, as investors begin to fear a repeat of the global financial crisis. Remember, this was seen almost 12, 13 years ago in 2008. We've lived through this. So after that experience, when you see a sign of a similar problem, you're going to take precautions. And the precautions are you're running to the bank to get the money, which makes it even more worse. So by Friday morning, trading, and everyone's trying to sell their stocks of Silicon Valley Bank, uh, they had to halt the trading, and it had abandoned efforts to raise the capital, because right now, Silicon Valley is trying to raise capital to plug the hole of 2.25 billion, and their shares had to be halted, because there was so much, the prices were dropping so fast to raise the capital, or find a buyer. So they can't raise capital and they can't find a buyer. And that comes directly from CNN. So you're welcome to check out the link. Um, with that being said, Federal Reserve interest rates raised 7 times, as I mentioned, last year, 2022, and earlier 2023 as well, making it 4.5% at the end of the year. Another 25 basis hike. I think those numbers are Canadian. Yeah, those numbers are Canadian. However, we'll just move on. The numbers are Canadian. The numbers are slightly different. However, the Fed still continue to buy billions of dollars worth of bonds to stimulate the economy, all despite 40-year high in various measures of US inflation. During these interest rate hikes in 2022, why didn't they do something to prevent the collapse? That's the first question I have. And I'm sure you have. We'll figure that out in the next presentation, by the way. So with that being said, there's a lot of uncertainty right now in the market with all this going on for the last few days. And I wanted to break this down. And there's a couple other presentations that I'm doing on this. The huge part lies in liquidity. Not having enough liquid cash, to fulfill the request of the depositors puts the bank in this position. With that being said, there is another presentation on its way. Connect with us. You can call, text, email. There's a website, Facebook, Instagram, TikTok, and don't forget to download the mortgage app, FaizalGarasia.com. You can play with that app and everything is at your fingertips. Thank you very much for being here, and I'm going to end this live.